welcome to Looking at the Markets with David Modell. Just wanted to discuss today why I buy in the money options and not out of the money options. In fact, I would rather sell out of the money options and buy in the money options. And I'm going to give you a few examples. Okay, so let's start with this example. This is SPY calls, and SPY is the spiders, which is an ETF that tracks the S&P 500. Okay, and this is from August 19, 2016. All right, and on August 19th, SPY was trading at 218 and 59 cents. All right, so let's look at the price action. As you can see, SPY was down a little bit, just a tiny bit, 0.13%. All right, and so if you bought a call option, it would be understandable if your call option lost a little bit of value. It shouldn't lose too much, though. I mean, this is a really small down move. So let's look at 225 calls. Okay, so that's out of the money, and these are expiring September 16, and so this is about a month expiration date, 1 month out. Okay, and even though the underlying equity went down just a tiny bit, look at how much the out of the money call option went down. It went down 28.5% about. That's pretty devastating for one day. All right, now let's compare that to an in the money call. This is a 210 call, also expiring the same date, about 1 month out, and it only went down about 3%, which for an option really isn't that bad. All right, and so the in the money call behaves more like the stock does, or the ETF. You know, the SPY went down a little bit, the option went down a little bit. All right, so what we see here is that you can use, oftentimes you can use an in the money call option as a replacement for stock. It's like a low cost stock replacement. Okay, because the delta is higher, and so it behaves more like a stock, more like the stock or ETF itself. All right, and so we can see the huge difference here, 3% versus 28.5%. All right, and so if you're going to buy anything, buy in the money and sell out of the money, because if you sell an option, you want it to go down in value quickly. Let's look at another example. These are Apple calls. All right, and as of August 19, 2016, Apple was trading at 109 and 27 cents, and it went up a little bit. All right, not much, but it went up a tiny bit. And so if you bought a call option, you would expect it to go up, not down. But take a look. This is a 120 call, so it's pretty deeply out of the money here, and it's expiring September 16th. So again, it's about a month out in expiration date. And look at that. The underlying stock here went up a little bit, but the call option went down. In fact, it went down a little bit over 16%, almost 17%. All right, that's got to hurt, especially when you're watching the stock go up a little bit. Meanwhile, the in the money call, and this is pretty deeply in the money here. This is a 90 call. All right, again, expiring about 1 month out, and same expiration date. And it behaves more like the stock. This would be a good stock replacement, a deeply in the money call. The underlying stock went up a little bit, and the call option went up a little bit, as opposed to going down almost 17%. Okay. And here's another example, GLD. All right, that is the gold ETF, GLD. As of August 23rd, 2016, GLD was trading at 127.89. On this particular day, it went up a tiny bit, not much. Okay, it's almost flat, but it went up a little bit, and so you would want your call option to go up a little bit as well. But look at this. Now again, these are expiring 1 month out. Okay, September 23rd call. This is out of the money, and it's kind of pretty far out of the money, 140 call. And look at that, went down 9.5% about. All right, and that's on a day when the underlying went up a little bit. Meanwhile, the in the money call, the 124 call here, same expiration date, 1 month out, it went up a little bit, just like the underlying did. So, you know, this is how this is a great or good stock replacement strategy. It doesn't always work like this, but oftentimes it does, because as you can see, the in the money call option behaved a lot like the stock did, or the ETF. The ETF did. The underlying went up a little bit, and the call option went up a little bit, instead of going down almost 10% like the out of the money call did. All right. So I hope this was helpful and educational for you, and I hope it showed why I buy in the money options, not out of the money. In fact, I might even sell out of the money options, but I certainly would not buy them in most cases. All right, so if you'd like more help with any of this, with finance, options, stocks, investing, trading, and so on, I can help you. My name is David Modell, and you can contact me at David Modell, and that last name is spelled Moadel, at gmail.com. All right, and if you like this video, please give it a thumbs up on YouTube. You can leave a comment. I like your comments. I like to read them. And subscribe to my channel so you can get the latest updates on my finance and educational videos. Thank you so much, and I hope to hear from you soon.